Which of the following is true for exchange-traded funds? Which of the following is true about ETFs? With ETFs, you want to remember that the Securities Exchange Commission, SEC, has classified them as a type of open-end fund. ETFs are a type of open-end funds, and they have operating costs and expenses that are lower than most mutual funds. So you want to remember ETFs, type of open-end fund, has lower expense ratios than most mutual funds. ETFs, exchange traded funds, is which of the following? When it comes to exchange traded funds, you also want to remember that they can be bought and sold throughout the trading day. And like I said before, ETFs have a low expense ratio. So ETFs, low expense ratio, classified as a type of open-end fund, can be bought and sold throughout the trading day. Which of the following is true regarding general partners in a limited partnership? So which of the following is true about general partners? You want to remember that when it comes to general partners, they should participate in day-to-day management of the partnership. So you want to think general partners is the boss. They make the rules, they handle daily decisions, and they take on unlimited personal liability. Whereas limited partners, they're just like a silent investor. They provide the cash, but cannot manage operations. That's the general partner's responsibility. If a limited partner attempts to manage the business, they lose their limited liability protection. An investor has purchased a senior unsecured debt security that trades on an exchange and is issued by a financial institution. It is backed only by that institution's good faith and credits. The security tracks the performance of a particular market index, but does not represent ownership in a pool of securities, the way share ownership in mutual funds does. This security that pays no interest and has a stated maturity date is known as the security that they are describing would be known as an exchange traded note. You always want to think notes as debt. So whenever a question describes an exchange traded product that is a debt security backed only by the good faith and credit of an institution, that's how you know it is an ETN, exchange traded note. Unsecured, backed by the faith and credit of a financial institution, and its debts. Notes are debts. An investor in a direct participation program wishes to divest of a partnership interest purchased from some time ago. You would directly advise that. An investor in a direct participation program wishes to divest of a partnership interest purchased some time ago. You would correctly advise that there is no secondary market, making them highly illiquid. So you remember, when it comes to direct participation programs, DPPs, limited partnerships, you remember that means locked in. Direct participation programs, limited partnerships, you can think are locked in. As in, direct participation programs do not trade on a public exchange like regular stocks. It's illiquid because there is no active secondary market. So getting out of a direct participation program is incredibly difficult. You are effectively stuck in the partnership unless you get special permission to transfer your ownership to someone else privately. So connects illiquid with direct participation programs, and connects no secondary market. They do not trade on the secondary market for direct participation programs. All the following would be advantages of a limited partner in a direct participation program, except all the following would be an advantage of limited partners in a DPP, except. So which one is not an advantage for limited partners? That would be participate in the management of the business is not an advantage of limited partners. So you always want to think limited partners means limited control. A limited partner is a silent partner, a silent investor. They're not involved in management or day-to-day operations. If a limited partner starts managing the business, they legally lose their limited liability protection and become personally responsible for all business debts. Investors in exchange-traded notes, ETNs, should understand that the primary risk associated with ETNs, exchange-traded notes, is the primary risk of ETNs. Remember, ETNs are only backed by faith and credit, right, of the institution. So unsecured. Remember, notes are debt, so the biggest risk they face would be default risk. So once again, ETNs, you want to think debt. Debt has credit risk or default risk. Since an ETN is an unsecured note, which is debt issued by a bank, you are completely dependent on that bank staying financially healthy. A difference with an ETF owns real stocks. So if the bank goes under, your stocks are still safe. But with the ETN, an ETN owns nothing but a promise. If the bank goes belly up, they default on that promise. ETFs are backed by securities. ETNs are backed by promises. A real estate investment trust can avoid being taxed as a corporation by which of the following is a way a real estate investment trust can avoid being taxed as a corporation? Real estate investment trusts can avoid being taxed as a corporation by receiving 75% or more of its income from real estate and distributing 90% or more of its net investment income to its shareholders. So with real estate investment trusts, it's important to remember the 75-90 rule, where 75% of its assets and income must come from real estate, and 90% of its net investment income must be passed out to shareholders. So remember 75-90 rule for real estate investment trusts. 75-90 are the percentages to remember. Your client asks about exchange-traded notes for her portfolio, and during the course of the conversation, she makes several statements. Which of the following is true? Which one of these statements about exchange-traded notes? Last few questions were about notes. So which of the following is true about exchange-traded notes? Well, like I said before, you want to remember notes equals debt securities. And debt securities backed by what or who? Only backed by the promise of the issuer. Exchange-traded notes are only backed by the issuer, backed by the bank. Regarding exchange-traded funds, ETFs, as compared to open-end mutual funds, which of the following is true? Which of the following are true comparing ETFs to mutual funds? Which of the following is true comparing ETFs to mutual funds? Regarding exchange-traded funds as compared to open-end mutual funds, the following that are true would be 1 and 3. So ETF transactions are subject to commissions is true, and ETFs may trade at a price that is less than the net asset value per share. So you want to remember ETFs trade like stocks. So because they trade on a live stock exchange, you pay brokers commission to buy or sell them. You pay a broker's commission. And you can buy them on margin, which is borrowed money. As far as the market price and the net asset value, as far as mutual funds always trade exactly at their net asset value, calculated at the end of the day. whereas ETFs trade all day based on supply and demand, meaning their price can fluctuate slightly above or less than their net asset value. Which of the following is true of income received from in achieving a better life experience account, otherwise known as an ABLE account? Which of the following is true of income received from an ABLE account? The following that is true about income received from an ABLE account would be that the income is tax-free. So income received from an ABLE account is tax-free. You want to think ABLE accounts is like a 529 plan for disabilities, where ABLE accounts work exactly like 529 college savings plans, but they are designed to pay for disability-related expenses instead of college tuition. The tax perk is that growth and withdrawals are completely tax-free as long as the money is spent on qualified disability expenses like healthcare, housing, or transportation. Advantages enjoyed by limited partners in a partnership might be all of the following, except. So in other words, which of the following is not an advantage enjoyed by limited partners? The one that is not an advantage enjoyed by limited partners would be C, being in a fiduciary position with responsibilities to others. So you just want to remember that general partners, the boss, is the fiduciary. The general partner, the boss, runs the business and has a legal obligation, which means a fiduciary duty to look out for the investors. Limited partners, you just want to think more as the passenger. The limited partner is just a passive investor. Passengers do not owe a fiduciary duty to the ship or the car. Only the captain. Only the general does. Limited partnerships sold through private placements involve limited partnerships sold through private placements involve a small group of investors, each contributing a large sum. So you would think private placements as like a country club, where it's a small group of wealthy investors, also known as accredited investors, with massive minimum investments. Private placements like a country club. And then you have, public offerings, which is like a mass market. A public offering would be a large group of regular people with small minimum investments. but private placement would be large. At the time of dissolution, let's say company going bankrupt, which of the following regarding a limited partnership is true? At the time of dissolution, which of the following regarding a limited partnership is true? There'll be limited partners are paid before general partners. So when a partnership dissolves, you want to think of the liquidation order as a line at a bank where outsiders always eat before insiders. So you have creditors, which are secured lenders, the IRS and general suppliers always get paid first. And then after creditors getting paid first, you have limited partners that get paid second. Limited partners, once again, are the passive investors who provided the capital. And then general partners get paid third when a partnership dissolves. And general partner, once again, are just the bosses who ran the operation. They are always at the absolute back of the line. General partners are always at the back of the line. Which type of DPP, which type of direct participation program would be least likely to enable the investor to claim a deduction for depreciation? Which type of direct participation program would be least likely to enable the investor to claim a deduction? The one that would least likely allow the investor to claim a deduction for depreciation would be Raw Lands Limited Partnership. So when it comes to depreciation, you want to think depreciation is like wear and tear. You can only claim a depreciation deduction on things that break down, wear out, or spoil over time, like buildings, computers, airplanes, or machinery. Dirt doesn't rot, so raw land is just dirt. Because land does not wear out or decay, it can never be depreciated under IRS rules. Raw land can never be depreciated or have a depreciation deduction. Which of the following statements regarding ETFs, exchange traded funds, and mutual funds is true? What statement about ETFs and mutual funds is true? The true statement about ETFs and mutual funds would be that both may be open-end management companies. Both ETNs and mutual funds may be open-end management companies. So when it comes to legal structure, you want to remember legally under the Investment Company Act of 1940, Investment Company Act of 1940, both mutual funds and ETFs fall under the definition of an open-end management company. The difference between the two is delivery. They share the same structural engine, but mutual funds route through the fund issuer directly once per day, while ETFs trade continuous shares live on a public exchange stock tracker. So the difference between the two is delivery, but they're both open-end management companies. An exchange-traded fund, ETF, is normally organized as which of the following? Like we've seen a few questions now, ETFs, once again, are open-end investment management companies under the Act of 1940. ETFs, open-ends. All of the following are concerns regarding private, non-traded real estate investment trusts, except all the following are concerns regarding private, non-traded REITs, real estate investment trusts, except which one is not a concern would be tax treatment. Tax treatment is not a concern regarding private, non-traded real estate investment trusts. So you want to remember, real estate investment trust rules apply to all real estate investment trusts, meaning whether a real estate investment trust trades publicly on Wall Street or is a private non-traded fund, the IRS treats them exactly the same way. So the conduit benefit is that as long as any real estate investment trust passes through 90% or more of its investment income to investors, it avoids paying corporate taxes on that portion. Therefore, tax treatment is a major benefit, not a concern. Which of the following securities are non-exempt from registration under the Securities Act of 1933? So which of the following securities are non-exempt from registration, meaning which of the following must be registered under the Securities Act of 1933? Which of these must register? The one that's non-exempt from registration and must register would be real estate investment trusts and corporate equity issues. So both corporate stock, corporate equity, and real estate investment trusts are public investment vehicles issued by commercial companies to raise capital from regular investors. The SEC strictly requires full registration of both real estate investment trusts and corporate equity issues, corporate stock. And an example of securities that are established by states to provide other government entities such as cities, towns, and school districts or state agencies with a short-term investment vehicle to invest funds include example securities established by states to provide other government entities such as cities, towns, and school districts or state agencies with short-term investment vehicle to invest would be local government investment pools. Local government, so you can just think cities, towns, the state, local governments. So when local governments, cities, towns, school districts have extra cash from tax revenue sitting around, they want a safe place to park it. So local government investment pools. The name says it all. Local government investment pools is exactly what it sounds like, which is a pool set up by the state where local governments can team up and invest their funds together, much like a municipal money market fund.